Money Power Fraud presents The Structured Collapse of Zeek Rewards. Chapter 1, Executive Exposure, The Illusion of Profitability. Over $600 million in participant capital was exposed, not through market volatility, through structural design. The system presented daily returns, consistent, predictable, and fundamentally unsupported. Profit was reported, but not generated. That distinction mattered. Capital entered through affiliate bid purchases. It was classified as participation, not liability. This created a false signal. Revenue appeared diversified. It was not. Payouts were issued daily, framed as a share of company earnings, but no verifiable earnings engine existed. Returns were calculated internally, using profit points, not actual cash flow. Balances increased on dashboards. Confidence increased with them. Liquidity did not. This is where the system begins to fail. Liabilities accumulated silently, not on a balance sheet, inside participant accounts. The structure depended on continuous inflows. New capital sustained existing payouts, not operational performance. Growth masked the dependency. Expansion concealed the risk until it could not. Withdrawal demand introduced pressure. Liquidity constraints became visible. The model could not absorb both. The system appeared solvent. It was not. What followed was predictable. Inflow velocity slowed, outflow pressure increased. This created a mismatch. Obligations exceeded accessible capital. Immediately, this was not a failure of execution. It was a failure of structure. The underlying mechanism was simple. Capital entered through affiliate participation. It was redistributed as returns. Without independent revenue support, this created artificial stability, short-term consistency, long-term inevitability. The collapse did not require a trigger, only time. This breakdown follows three phases: how capital was aggregated, how exposure was concealed, why collapse became unavoidable. Chapter 2, System Architecture, Revenue Share as a Disguised Ponzi Layer. The platform presented itself as an advertising network, not an investment vehicle. That distinction was intentional. Affiliates purchased VIP bids. These bids were positioned as advertising credits, not capital deposits. Participation unlocked daily profit sharing. Returns were framed as revenue-based, not recruitment-based. This created a critical perception shift. Users believed they were buying exposure, not funding payouts. The underlying mechanism was different. Capital entered through bid purchases. Those funds were pooled internally. No external revenue validation existed. Daily returns were distributed from this pool, not from advertising performance, but from available liquidity. This is where the structure becomes clear. The system required two conditions: continuous capital inflow, controlled capital outflow. Inflows came from new and reinvesting affiliates. Outflows were restricted through system design. This preserved short-term stability. The revenue share label obscured this dependency. It implied operational earnings, but none were required for payouts. Advertising activity existed, but it was economically insignificant relative to payout obligations. This created a masking layer, a visible business activity, with no functional role in sustainability. The structure operated as a closed loop. Capital entered from participants. It was redistributed to participants. No external value creation occurred, only internal redistribution, at increasing scale. This is the defining characteristic. The system appeared like a hybrid model, part affiliate marketing, part revenue sharing platform. In reality, it was singular, a capital recycling mechanism. What followed was structural expansion. More participants entered the system. More capital reinforced the illusion, and the model appeared to work, until scale exposed the dependency. Chapter 3, Capital Aggregation, Incentivized Inflows at Scale. Capital entered through affiliate participation, not investment contracts. That distinction reduced resistance. Participants purchased VIP bids. Larger purchases increased qualification levels. Higher levels unlocked larger daily returns. This created a scaling ladder: more capital, more access. Daily returns reinforced behavior. Balances increased consistently. Confidence followed. Most participants did not withdraw. They reinvested. By design, compounding was encouraged, not optional, but structurally incentivized. This accelerated capital concentration. Existing users increased exposure. New users expanded the base. Recruitment amplified inflows. Affiliates earned on downline activity. Expansion became economically attractive. This created a dual engine: internal reinvestment, external recruitment. Both drove capital velocity. The system did not need exponential growth. It engineered it. Participation thresholds reinforced escalation. To maintain earnings levels, users increased capital commitment. Lower tiers became inefficient. Higher tiers became necessary. This pushed capital upward. The structure converted participation into obligation. To sustain returns, users had to scale exposure. This is where aggregation intensifies. Capital inflows became predictable, daily, consistent. Outflows remained controlled. Withdrawals were limited behaviorally, not technically. Reinvestment dominated withdrawal activity. Liquidity remained inside the system, temporarily. This created a stable illusion. Inflows exceeded outflows, until they did not. The system scaled rapidly because friction was low and perceived returns were high. But scale introduced pressure. Obligations increased with every new participant and every reinvested dollar, without corresponding revenue support. This created a growing imbalance as the system appeared stronger as it grew. It was becoming weaker. What followed was predictable. Capital aggregation reached structural limits, and exposure became irreversible. Chapter 4, Obfuscation Layer, Accounting Without Economic Substance. The system did not track profit, it tracked allocation. That distinction defined the risk. Internal balances were displayed as earnings, but they were not realized gains. They were system-generated values. The core unit was profit points, not cash, not verified revenue. Daily returns were calculated from these points, using internal formulas, not external performance data. This created a controlled environment. Inputs were known, outputs were adjustable, participants saw consistent growth. Balances increased daily, without volatility. That consistency was the signal. Real revenue fluctuates. This system did not, because it was not tied to revenue. No audited linkage existed between advertising activity and payouts. The connection was implied, not proven. This is where the masking layer operates. Liabilities were not recorded traditionally. No balance sheet reflected total obligations. Exposure remained internal. Participant balances represented claims, but not enforceable assets, only system-recognized values. This created artificial solvency. The platform appeared liquid because withdrawals were limited behaviorally, not because reserves existed. As long as withdrawals stayed low, the illusion held completely. This is critical. Accounting systems can simulate stability without underlying economic support. If inputs are controlled, Zeek rewards controlled both allocation and presentation. What followed was scale amplification. As more capital entered, more points were issued, more liabilities accumulated, but nothing offset them. No external earnings, no retained capital base, only incoming funds. This created a widening gap between perceived value and actual liquidity. The system appeared balanced. It was not. The imbalance remained hidden because visibility was restricted to internal reporting. This is where failure becomes embedded. The accounting did not fail. It functioned exactly as designed, to conceal structural exposure. Chapter 5, Incentive Distortion, Behavior Engineered for Retention. The system did not rely on trust. It engineered behavior. Returns were issued daily, small, consistent. This created reinforcement, frequent rewards, minimal resistance. Participants checked balances daily. They observed growth. They internalized stability. Withdrawal was possible, but discouraged and indirectly. Reinvestment was positioned as optimal, to maximize returns and to maintain qualification levels. This created a bias toward retention, not exit. The structure rewarded inactivity. Capital remained inside the system by design. This is where control emerges. Higher tiers required larger balances to sustain earning percentages. Users increased exposure. Falling below thresholds reduced returns. This penalized withdrawal. Behaviorally, the system did not block liquidity. It made withdrawal irrational. Recruitment added another layer. Affiliates earned from downline activity. Expansion became financially aligned. Participants became distribution channels, not just capital providers, but growth drivers. This amplified system stability temporarily. The incentive structure suppressed risk signals as long as returns continued. Concern remained low. Daily payouts created trust. Trust created reinvestment. Reinvestment sustained payouts. This loop was self-reinforcing, but it introduced fragility. Participants were not diversifying exposure. They were concentrating it inside a single system. This increased systemic risk without awareness. The longer the system operated, the stronger the behavioral lock-in became. Confidence replaced analysis. Habit replaced scrutiny. This is where failure accelerates. Once confidence breaks, behavior reverses. Rapidly, reinvestment stops. Withdrawals increase. That liquidity is tested. The system depends on stability in behavior, not structure. When behavior shifts, the system cannot adapt because it was never designed to. Chapter 6, hidden fragility, dependency on continuous growth. The system appeared stable because growth remained constant. Stability was not structural, it was conditional. The model required continuous inflows. New capital sustained existing obligations, not underlying profitability. This created a dependency. Growth was not optional. It was required. Every new participant added capital and liability simultaneously. This is the core imbalance. Obligations accumulated daily through internal balance allocations without offsetting revenue. As long as inflows increased, the gap remained hidden temporarily. But the system had limits. Growth must exceed withdrawals consistently at scale. If inflows slow, pressure begins immediately. This is where fragility becomes visible. The system had no buffer, no retained earnings, no liquidity reserve, only incoming funds. This created a narrow operating window. High inflow, low outflow. Any deviation introduced stress. Participant behavior amplified the risk. Reinvestment delayed withdrawals, but did not remove obligations. Liabilities continued to grow. Quietly, continuously, this increased systemic exposure without detection. The structure resembled stability because variables were controlled. Externally and internally, imbalance expanded. This is the hidden layer. The system could not withstand equilibrium, let alone contraction. If inflows matched outflows, failure begins. If outflows exceed inflows, collapse accelerates. This is mathematically constrained. The larger the system grows, the greater the dependency on continued expansion. Scale increases fragility, not strength. This is the inversion. Growth signaled success, it indicated risk. What followed required no external shock, only a change in flow, and that change was inevitable. Chapter 7, Trigger Event, Regulatory Intervention, and Liquidity Shock. The system did not fail in isolation. External scrutiny accelerated exposure. Regulators identified inconsistencies. Revenue claims lacked verification. Payout structures lacked legitimacy. This is where pressure begins. The model was reviewed, not as an advertising platform, but as a capital redistribution system. That reclassification mattered. What followed was enforcement action. Operations were challenged. Claims were examined. Confidence shifted immediately. Participants began to question returns, not the amount, the source. This changed behavior. Reinvestment slowed. Withdrawal intent increased. Liquidity was tested. The system was not designed for this. Daily payouts required steady inflows. Now inflows declined. Outflows increased. This created a mismatch. Available cash contracted. Obligations remained fixed. Pressure intensified. This is the trigger point. The system faced simultaneous stress, regulatory exposure, liquidity demand. It could not absorb both. Withdrawal requests increased rapidly. Confidence deteriorated in real time. Network stability collapsed. The structure began to unwind. Payout delays signaled weakness. Weakness accelerated withdrawal behavior. This created a feedback loop. Negative momentum replaced growth. This is where collapse transitions. The system no longer controls flow. Participants do, and behavior reverses. Liquidity becomes visible, not as strength, but as absence. This is the moment of exposure. The model required stability. It encountered stress and failed immediately. Chapter 8, Collapse Phase, Rapid Unwinding of the Network. Payouts began to slow, then stopped completely. This was the signal. Liquidity was no longer sufficient. Obligations exceeded accessible capital, immediately visible. Participant balances remained displayed, but they were no longer actionable, only internal values. Withdrawal requests surged, system capacity contracted, queues formed instantly. This is where the unwind accelerates. Confidence collapsed across the network, not gradually, simultaneously. Reinvestment halted, recruitment stopped, inflow dropped to zero. The system lost its only support without new capital. Payouts could not resume at any level. This exposed the structure. Balances were not backed by assets, they were allocation entries without liquidity support. Losses became irreversible. Participants attempted to exit, but exit required liquidity, which did not exist. This created a hard lock. The network began to fracture. Top-level affiliates lost downline activity. Earnings collapsed instantly. Lower-tier participants absorbed losses disproportionately, completely. This is the distribution pattern. Early participants exited with gains. Later participants held unrealized balances. That converted to zero. The structure resolved itself, not through recovery, through depletion. Available cash was exhausted. Outstanding obligations remained unpaid. This is terminal failure. The system could not restructure. It had no revenue base, no recovery pathway, only collapse. What remained was exposure, quantified losses, and a fully visible mechanism. Chapter 9. Institutional failure, oversight lag, and detection gaps. The system did not operate unseen. It operated misclassified. Regulatory frameworks existed, but classification delayed enforcement. That delay increased exposure. Zeek rewards presented as advertising, not as an investment scheme. This altered scrutiny thresholds. This is where detection failed. Revenue sharing language obscured intent. Participation was framed as business activity, not capital contribution. This created ambiguity. Regulators require clear signals, investment contracts, securities offerings. Those signals were diluted. The structure exploited that gap. Capital flowed without immediate classification. Oversight lagged behind scale. This allowed aggregation. By the time scrutiny increased, the system had already expanded significantly. This increased systemic exposure. Information asymmetry amplified the risk. Participants lacked forensic visibility. They relied on platform reporting. No independent verification existed. Audited financials were absent. Revenue sources were unconfirmed, but payouts continued. This reinforced perceived legitimacy. Institutional response requires evidence. Evidence requires access. Access was limited. This delayed intervention. When action occurred, it was corrective, not preventative. This is the critical failure. Oversight did not stop formation, and it responded to collapse, and the structure remained intact until liquidity pressure exposed it. This is the pattern. Detection follows visibility. Visibility follows failure. By then, exposure is locked. What followed was enforcement. Asset freezes, operational shutdown. But capital had already moved. Recovery was limited. Losses were realized. Systemic risk had already materialized. This is the institutional lesson. Regulatory lag is not neutral. It increases total loss, especially in systems designed to scale before detection. Chapter 10. Forensic breakdown, input to manipulation to outcome. The structure can be reduced to a single operational loop. Input, manipulation, outcome. This is where clarity emerges. Input began with affiliate capital. Through VIP bid purchases, framed as advertising participation, funds entered continuously from new participants and reinvesting participants. This created the capital base that the system did not separate deposits from operational funds, that they were merged. This is critical. Once inside the system, capital was reclassified as business activity, not investor liability. This allowed redistribution without formal obligation tracking externally. The next phase was manipulation. Internal accounting generated profit points. These points determined daily returns, not real earnings. Allocations were calculated centrally, using controlled formulas, invisible to participants. This created consistency. Returns appeared stable, predictable, independent of market conditions, because they were. No external revenue input was required, only sufficient liquidity from ongoing inflows. This completed the manipulation layer. The final phase was outcome. Participants received daily returns, credited to internal balances, not necessarily withdrawn. Most returns were reinvested, increasing total exposure system-wide. This reinforced the loop. Input increased, manipulation scaled, outcome sustained perception until flow changed. When inflows slowed, the manipulation layer could not adjust. Liquidity constrained distribution. Outcome collapsed immediately. This is the full cycle. No external shock required, only imbalance. The system functioned efficiently as long as inputs exceeded outputs. When that condition failed, the system failed completely. Chapter 11. Systemic implications, replicable fraud architecture. Zeek Rewards was not unique. Its structure is repeatable. The model did not depend on branding. It depended on architecture and incentives. Revenue sharing constructs can mask exposure. If payouts are decoupled from real earnings and linked to participation, this is the first signal. Internal accounting can simulate profitability through controlled allocation systems without external validation. This creates artificial stability. Consistent returns reinforce belief. Belief drives reinvestment. Reinvestment sustains payouts. This loop is transferable, and the platform layer can vary. Advertising, crypto, e-commerce. The mechanism does not change. Capital enters from participants. It is redistributed to participants without independent revenue support. This defines the structure. Incentive engineering extends lifespan. Reinvestment suppresses withdrawals. Recruitment accelerates inflows. This delays exposure. Growth is interpreted as success. It is structural dependency. This is the inversion. The larger the system becomes, the more fragile it is. Under liquidity stress, scale amplifies risk, regulatory lag enables expansion, classification ambiguity delays intervention, detection follows visibility, visibility follows failure. This pattern repeats. The structure evolves in presentation, but not in function. Each iteration refines concealment, not sustainability. This is the systemic implication. These systems do not collapse randomly. They collapse predictably, under the same conditions. Inflow contraction, outflow acceleration, liquidity failure. The architecture ensures it. Chapter 12, Strategic Defense, Identifying Structural Risk Signals. The structure can be detected early if the correct signals are observed. Start with revenue source validation. Identify where payouts originate, not where they are reported. If returns depend on participant inflows, risk is embedded immediately. This is the primary signal. Next, analyze payout consistency. Stable daily returns require stable revenue. Verify that linkage if variability is absent, but markets are variable. The system is controlled. This indicates artificial allocation. Evaluate accounting transparency. Are earnings externally audited or internally calculated? If calculation replaces verification, exposure is concealed. This is a critical indicator. Assess incentive structures. Are participants encouraged to withdraw or to reinvest continuously? If reinvestment is dominant, liquidity is being retained, not generated. This delays failure. Examine withdrawal friction, not technical restrictions, behavioral penalties. If withdrawing reduces future returns, exit is discouraged, system stability is forced. This increases risk. Analyze growth dependency. Does the system require expansion to sustain payouts? If growth slows, does pressure appear? Immediately. This reveals structural reliance. Look for liability visibility. Are participant balances reflected as obligations on financial statements? And if not, exposure is hidden. This creates false solvency. Evaluate business activity relevance. Does the product generate meaningful revenue relative to payouts? If activity exists, but is economically insignificant, it is a masking layer. This is common. Finally, test stress tolerance. If inflows stop, can the system sustain payouts? If not, failure is already present. These signals do not require access, only analysis. The structure reveals itself through inconsistency between appearance and function. This is the defense, not prediction, detection. Chapter 13, Closing Analysis, Inevitability of Structural Collapse. The system did not fail unexpectedly. It failed as designed. Capital inflows substituted for revenue from inception, not temporarily. This defined the outcome. The structure appeared profitable because payouts were continuous, not because value was created. That distinction determined collapse. Growth extended lifespan. It did not reduce risk, it amplified it. Every new participant increased exposure. Every reinvested dollar increased obligation. Without offset, this created inevitability. The system required imbalance, inflows exceeding outflows. At all times, that condition cannot persist indefinitely. At scale, this is the constraint. Once equilibrium approaches, failure begins immediately. Once contraction begins, collapse accelerates completely. This is not a scenario. It is a certainty. Zeek rewards did not collapse due to mismanagement or external pressure alone. Those accelerated exposure. They did not create it. The failure was embedded in the capital flow design from the beginning. This is the critical takeaway. Fraud at this scale is not chaotic. It is structured, systematic. The outcome is predictable. If the mechanism is understood, this is why detection matters, not after collapse, before capital aggregation completes, because once exposure is realized, recovery is limited, and losses are permanent. This is the final condition. The system appeared stable. It was not. It appeared profitable. It was not. It appeared sustainable, and it could never be.